Hello, I'm Olivier Jonin from Catch Business School, and on this presentation I'm going to compare two US companies, Lowe's and Big Lots, using the HOLT valuation methods. The first one is Lowe's, a US company focused on home improvement retail with a revenue of almost 90 billion US dollar. The second one is a smaller company, which is Big Lots, a company focused on discount stores with a revenue of 6.2 billion US dollar. So as you can see on the first graph, the company maintained its CFROI above its cost of capital, which means the company created value over the time. In terms of growth, in 2020, Lowe's recorded a positive performance of plus 20%, which is mostly due to the positive impact of the COVID-19. In terms of operating margin, 2020 is the first year where operating margin are higher than the average of the industry. And just to conclude, you can see that the stock reacts pretty well on the market as it's overperformed relative to the S&P 500 index. So what about Big Lots now? You can see that during the two last years, the company was destructing value because its cost of capital was higher than its CFROI. But maybe, as you know, the company is changing its strategy. This is why we expect a rebound over the years in the future. In terms of growth, you can see that is relatively stable. What about operating margin? They are higher than the average of the industry. And just to conclude briefly, on the market compared to the S&P 500 index, the company is getting back to positive performance since 2019. So now it's time for a recommendation. So I strongly advise you to buy Lowe's instead of Big Lots, even if Big Lots is a good stock to have. Why? Because thanks to the HOLT method valuation, we can expect a warranted price of plus 35% for Lowe's compared to plus 19% for Big Lots. And according to me, Lowe's has better fundamental with better CFROI and a lower cost of capital. And as we have seen, the company reacts positively of the COVID-19 crisis and overperform relative to the S&P 500 index.